Tom Browning passed away yesterday unexpectedly at age 62 at his home. His wife of 40 some years passed away in March, and that had weighed on him heavily, although Marty Brenneman, the famous announcer, was with Tom 2 days ago and said that he was chipper, cheerful, and his normal self. Of all the famous people in sports, Tom would be in the top tier for reasons of modesty. His accomplishment is notable when he threw a perfect game the night of September 16th, 1988 in Cincinnati against the Los Angeles Dodgers. It was the 13th perfect game ever thrown. And what makes that interesting is this context. The number of times a perfect game could have been thrown at that point in time, 35 years ago, was 350,000. So 350,000 times a perfect game could have been thrown within professional baseball, which traces back to 1869. And he threw number 13. And it was a remarkable performance against a team where there was a lot of intensity between the two ball clubs. He went on to be a star performer in the 1990 World Series 2 years later, in which the Reds swept the Oakland A's in 4 games. And since his retirement in about 1994, he's been a fixture in and around the Reds, has given of himself enormously, and this gathering with the 361 group is reflective of his kindness, courtesy, and interest in others. He rallied with us in the prior June of 21, and we had a terrific time. Contacted him afterwards and said, look, you got to repeat again next year. And he did. And he agreed to let us talk with him in this fairly intimate way that's reflected in this recording. And for those 361 travelers who were there, we all agreed that it was a more meaningful than normal experience as we wander our way through the paths of life.
So I think it's then I'm just going to show a few clips of that, Jack. That's okay.
Sure.
And I was just, of course, I don't have it immediately at hand, but I will give it a moment. Here it is. All right, I have it on a different screen, so we're going to share different screen. I think we'd figure out the Zoom thing by now.
You know, the signage there in front of us underscored the fact that a crew, one of our favorite companies, sponsored this gathering.
17, and those numbers underscore the extent to which your accomplishment was by definition extraordinary. How did it feel?
Well, obviously, I've talked about it before. You're never going to a game hoping to throw a perfect game. A shutout, I obviously, when I towed the rubber, my intentions were to go 9 innings and hope we throw a shutout. But worst case, we win the ball game and I'm able to go 9, which didn't happen but 10% of the time. And I remember that vividly because I had retired the last 11 hitters I faced in LA. I pitched against the Dodgers his previous start, and I retired the last 11. I got beat 2-1.
And the same pitcher.
Correct. Timmy Belcher hit a 2-run home run off me, and I got beat 2-1.
We were kind of annoyed when he hit that home run.
Yeah, not as bad. It was an 0-2 pitch, and Pete thought it was too good a pitch. I said it was on his shoe tops, and he scooped it out. So, but anyway, they came back into town, and we were still in the pennant race. We were still like 6 games out, even though there was only maybe 2 weeks of the season left. But because we were still mathematically in it, and I grew up a Reds fan my whole life, and I grew up a Dodger hater. So I didn't need any extra motivation to go against the Dodgers. and Tommy Lasorda. So it was just again, because we were still in the pennant race and it was against the Dodgers. I didn't need any extra motivation. It just worked out that way where nobody decided.
Well, one of my favorite parts of the story, when he told us he was with us the year before, as you said, was that he had a disagreement with his wife over cleaning up the garage. And the game started late and he had more time and more angst. There's always something, but it all combined and it worked. And I remember asking him, did he ever think about what pitch to pitch? And there was no decision. It was always a fastball. And yeah, we were just with him. And thank you, Jack, for bringing him and others into our fold. I wanted to try to show, looking at Cincinnati photos here, where we were at the ballpark. There's one in particular that Pete will remember. But yeah, here he is with us. But this was an interesting scene.
Oh, geez.
Now it's a party.
We just had to do this.
We had to do it.
No, it's just wrong.
I gotta find it though. Here we go.
No, that's good. You got enough there.
I say this is so right, not wrong.
Oh, for the love of God.
Not the same without the soundtrack.
This looks like I'm having a medical issue. Proud moments.
It has to be said right over here. Wait a second. Although I like this part. Here it is.
Jim's like going, we have demonic possession now. Okay.
But you see, we lost another good one. This is John Bellamini.
Yes.
Walking right here.
Yes.
So Jack, you talked about having a loop of Tom Browning talk. I was thinking we would just do a loop for a while with this video.
You know, Mark, payback is challenging sometimes.
Yeah.
Do you notice that Peter Bergen was the star of the show of all those people? He stood out the most.
Jack, you're the best.
So any other thoughts you want to share, Jack?
Well, the city of Cincinnati is in mourning, and there's a large graphic at the ballpark that says "We are heartbroken" with a picture of Tom. He's one of those persons that most people thought would never die. But so it is. Rest in peace. What a character. And what a loving person. His fame never affected him in any negative way. He spent the last 35 years just being responsive to, thoughtful of, and helpful to others. But his wife died in March, and that hit him hard.
Yeah, I bet that can do it.
You know, Jack, I made some notes today and I said, anyone in the 361 group that attended the Reds games the last 2 years would know, aside from being a special player, he's a terrific character and funny as can be and caring at the same time. Is my notes for today. So you summed it up quite well. And what a real nice man he was. For all the fame, he was really down to earth. Thank you for introducing us to him.
And as to that
I echo
accomplishment,
Steve's remarks there, Jack. I really do. It was really a treat.
Well, it's a joyful memory that Mark's clan was able to hang out with this guy and come to know him. And so it is with our respective life journeys that we've added this guy to our memory.
Indeed. Hi, Joe. Andrew, you met him the year before, September. So I did want to make I could show more pictures and of that year before. But I think we're 1 minute off, so I'm gonna switch back. Actually, just to remind people of where we're going next. A lot of Ohio connectivity, and that is in Florida. That's our next main event. We'll have 28 and 29, and then we'll move to Miami again, and there'll be a morning session and afternoon session, and a little wider programming that I mentioned earlier. We have a Zeitgeist panel. We'll talk about how the world's changing. It's a pickleball. Again, for the record, I think we should collectively try to buy a team. I think it would be I'm sure we could be a added value collectively. Then we'll have on impact and philanthropy. We're confirming Jacques Cousteau's grandson, who's building a really interesting underwater. It's almost like an station for research and otherwise. And then roundtables, and then there's a concert that night against human trafficking that Bo Beatty is putting together, and then focusing on some conference activity in the morning. Pickleball, we have 35 courts, so times 4, do the math. We'll have a great gathering. You don't need to know how to play pickleball. That we will have that practice and instruction. And then, believe me, I thought I was good. I wasn't. Then I became sort of good. It's easy to play. It's fun. And then we have our Miami event. So if you need a hotel, well, we have as you log in, we have a hotel at rooms at the Hyatt House. We're trying to get a link for Bayfront. That's the cheaper one. And if you really want to treat yourself, then there's an Inn on 5th, about 12 minutes away, and you can sign up here. I think by December 27th, I would say, yeah, we have 600, and then it goes up. So do sign in. Let us know where your interests lie as you sign in, and otherwise, just one quick screenshot of how we see the rest of the next year already, I should say, and that's here. And with Michael Sped, I was just with Michael in Dusseldorf and London. So we have this calendar for the year. There's a Riyadh event in coordination with PwC and Prestel. Our event in Florida. I may be leaving for Dubai. We'll see how the stars line up for that. London is going to start something that's other cities will do. It's sort of like once or twice a quarter, having their own lunches like we do in New York. And so glad to see that as a takeaway from our London event that we have had. Then there'll be a big conference, our flagship in the spring, and then an impact conference as we do. And then the West Coast technically will start on the 17th in the Seattle area with a special event. Then we'll have Seattle, San Francisco, Palo Alto, possible adding of San Diego, but we might just do a Southern California trip later. Omaha with Wanda. Singapore, we're hitting it twice, May and November. With the openings, we don't know if there's one place to go in Greater China, it would be Hong Kong. So we're hoping to make it back there. We have good friends to sort of see how they see the world. Istanbul, Tel Aviv combo, actually Istanbul, followed by Zurich. London again, Wiesbaden, Frankfurt, as we did, to be followed by London, another New York event, Zurich, Singapore, New York. Then New York will be our flagship at the end of the year. So, but that's just the tip of the iceberg. As we have a lot of other things that we've on our radar that we welcome you. And on Wednesdays is when we really want to go at this increasingly in spades and set up the breakout room so that these events can move from the right to the left. So we were just honoring one of our, I like to think he as our own, because he came, Tom Browning, and we were just sharing an interview that we did at the Reds game last year. So I'll just put this in the chat for everybody. And again, thanks to Jack Wyatt for helping us bring people like him into our network. So with that, I feel like we're inching closer to 150 now, Stephen. And oh, last thing is our predictions. I'll put that in the chat even first for everyone to so next week I'll be in Miami, and I will be hopefully we'll be sharing what we're seeing in predictions as part of a little mini analysis for what the community sees. And we've been doing that, as you can see on our, if you go to the 2023 page of 361 Firm, com/2023, you'll see this is a tradition. It started here with 2021 and all the videos that we did together, and we did it again in 2022. So here we are again. Time is flying. And so with that, and this is actually asking me, any questions before we turn to Stephen? If not, I will turn it to you.
Thanks, Mark. And this, not getting my presentation. Give me one sec here. Yeah, Mark, 150, and I still can't find my presentation on the screen here.
I know.
There we go. All right, can you see that? Or no?
Yep.
All right, let me go.
But I love it is that it came to us, and Anessa changed it from thinking about 2024 to 23. You're so far ahead. Steve.
Well, actually, it's funny because you could be, given the market's a discounting mechanism, we're not that far off from looking at the numbers about what it looks like at the end of the year next year. So this is an interesting time for thinking through all this. So I want to talk about 2023, but before I start, I did want to just congratulate Argentina, and what a great World Cup. I know we have a lot of World Cup fans here and soccer fans, but anyone who's struggling with their team's disappointment, give me a call. I'm a long-suffering New York Jets fan, so I can explain to you how you deal with regular disappointments from your favorite teams. But it was a great tournament, and really one of the best finals I've ever seen. So really, congratulations, and what a lot of fun. But then we go back to the real world, and we're dealing with the problems of real life, and whether it's war or inflation or cost of living, or just all the changes that are going on, and as well as the healthcare issues. Central banks are really pushing to respond to inflation. The question is, are they responding too much too late or not? We'll know that out into the future, but as you can see, the Fed, ECB, Bank of England, all raised rates. Overall, global short rates are being pushed up. And then today we had the Bank of Japan announced that they were raising their yield curve control range from plus minus 25 to plus minus 50 basis points, which actually has a pretty big impact rolling out through the economy, as the yen is one of the reserve currencies. It's up 3% on that move. Their yields are up to around 41 41 basis points, which is a 16 basis point move. So while the 41 basis points doesn't seem like that much, when you think about a 16 basis point move on 41, it's a significant change there. And it's a reflection of the fact that we're moving to a different economic environment. And we're in one of those, I think, significant transitions that's going to require a lot of rethinking of your portfolios. And I want to just be clear that when the Powell delivered his address last week, it was pretty much what we've talked about for the last month, 50 basis points. And he's going to be against the market, saying that don't expect the rate cuts to be coming through. And the market didn't want to believe that. And actually, it's funny how the inflation numbers are starting to change, and the pushback the Fed's getting for being too slow to lower rates again is supportive of the argument that some of the inflation was actually transitory. So we have this view of the world, and it just shows you how complex the dynamics are around inflation. But really what the Fed's fighting, and their biggest issue, is wages. And there's a mismatch in the labor markets, both of the catch up that's going on for certain unions that or certain industries that are now have a much better dynamics for the labor than they did for management. But you're also seeing inflation still being somewhat stubborn, although we've talked about signs of cooling. But from the Fed, their dual mandate, different than most other central banks, is not just inflation, but it's full employment. And that is the big challenge for them right now, because the labor markets are so screwed up by the economic gyrations of the last 2 years, whether it was the war, whether it was the pandemic, whether it was the trade wars, the sanctions and the like, have created big distortions. So we have a very hot labor market in the US, still with the mismatch of job openings versus the unemployed. And just to put this in some perspective, we were looking at numbers here where we have 6 million unemployed according to the U3 numbers, forget about the U6 number for a bit, where we're back down to basically pre-COVID levels for the unemployment rate. But we are also with a JOLTS number that is significantly higher, where we're looking at almost 10.7 million job openings. So this mismatch has to get corrected for the labor markets and wage pressures to start getting better in line. So this is what the Fed has been focused on, is they need to get unemployment to be higher. Actually, it's too low for where the economy is right now. And that adjustment process is taking longer than I think a lot of people thought it would take. But that's due to the fact that we've had such a herky-jerky reopening and closing of industries, and that's distorted the labor markets. And I think that's one of the things that we're still working through, where you've had this labor market out of whack because the stay-at-home jobs started to build, and then they started to go away, and then the return to work jobs are starting to be filled. So we're having these mismatches of labor and skills. At the same time, the types of functions that each job is being asked to do are changing and requiring different skills, which makes it harder to move forward. So I think we're going to have this period where you have a couple big forces driving things, and we'll get into them in a minute. But I want to just touch on some of the headwinds and tailwinds that the US economy is facing, what it might mean for the global economy more. So we've had this lagged impact of rates. We've had the higher rates, the higher bond yields, and higher oil prices all working through. And that's been creating a lot of headwinds for the system, which are now starting to reverse. So this is one of the things I talked about last week that's cooling this the short-term rate scenario. The strong dollar created some headwinds for the US economy, particularly for multinationals, but that's also starting to come in part because of the reactions of other central banks, like you saw today with the Bank of Japan, or you see the euro now is at, I think 106, almost 106.4. It was 98 not too long ago. So you are starting to see some changes there. But I think the biggest area and one of the hardest things for this environment is what's the outlook for corporate revenues and earnings, because of the inflationary aspects and the distortions that inflation is creating in the short term, and this reopening of the economy, both in the US and the rest of the world. And now with what happens with the reopening of China and China's COVID issues and the war, you have all these forces. And right now, one of the areas with the greatest variance of views is what is the outlook for corporate earnings for 2023. And the people we follow most closely would be ISI, Cornerstone, and Piper Sandler with Nancy Lazar, Ed Hyman, and Ed Yardeni. Nancy is very negative on earnings, and she's looking at a potential earnings for the S&P of 180 for next year. I think the market's around 120 right now. We have a couple of our strategists looking at the other two are down around 120. So you have a pretty big swing there in corporate earnings for next year. But if you think about the S&P earnings at 180, what multiple you're going to put on the market if earnings are down there, you'd probably be at maybe a 15 multiple, and you're looking at 2,700 on the S&P. If you go with the other end of the spectrum and you look at a 20 multiple and say you put an 18 multiple on that or a 17 multiple on it, you're looking at much higher numbers there. So a big bandwidth of potential outcomes for the S&P next year based on earnings. And I think that's going to be one of the big questions that you're going to be dealing with. And I think what we were focused on at ARS is the fact that you have to move away from thinking about the markets. When you move up of zero interest rates and all the central bank support and all the fiscal stimulus, you have to move, and moving back into a more normalized interest rate environment and a different geopolitical environment and a different inflationary environment. You have to think about the markets differently and forget about the markets and start thinking about which businesses can do well in an environment where multiples may come in, corporate earnings are coming in, and growth rates are slowing considerably. So I think these are some of the headwinds that are being faced. Some of them are becoming tailwinds, though. M2 slowed considerably. That was creating a lot of inflationary pressures. That's coming back down, and consumer net worth is in a decline. And that is going to change the mindset of people putting money to work. So spending is definitely changing there. I think the tailwinds for the economy are we have massive stimulus that's still working through the system. And when you think about it, it takes 18 months to 24 months for most of the stimulus to work through. And we popped $2 trillion in last year in extra fiscal stimulus that's still working through the system here. That's creating some of the support, and it's also creating some of the inflationary pressures that we're seeing. I think the big issue is the manufacturing renaissance that's underway. And when I talk about the fiscal stimulus, you can also talk about the Inflation Reduction Act, which is a pretty significant mislabeling, and truth in advertising needs to be shifted there. But that is spending that's going into the economy that's pretty significant, and the CHIPS Act. And those two issues are really redirecting capital back to the US and strengthening a lot of the opportunities. And when we talk about the 361 Ohio Tech Fund, they're a major beneficiary of what's going on with this manufacturing renaissance. The Midwest is killing it right now, and they're seeing big flows there. The other thing is inflation has created stronger corporate revenues for companies. Not all of them are going to be able to keep those revenues. Some are going to lose them, and you're already starting to see some of the discounting going on in retail. I think that's going to create another offset. But with the companies that do have strong revenues, they are making big investments, and they're going to separate themselves from their competitors pretty quickly. Because of the stimulus, we have a lot of excess savings in the system that still working through. So that means we still can keep our spending up. And that's one of the surprises of why the economy has been so strong against some of the challenges we've seen. Then the other element is, and I think you're going to see some big divergences next year and from strategists as to, is the US the best place to invest, or is the rest of the world best place to invest? And I think it depends on your time horizon, because I can make the case that for the next quarter or two that there'll be some interesting opportunities in Europe and China on reopenings and some of the other changes that are going through. I could also make the case that capital will continue to flow to the safe haven because of some of the challenges that are out there. And I think the last thing is we do have these headwinds that I talked about turning into tailwinds, and that could change the inflation picture. But I think we have to adjust to something very big. So let me just step back and talk about our view at ARS and how we see 2023, and then I'll open it up for discussion. But these changes in globalization that have come about because of the war and because of some of the geopolitical battles between democratic and autocratic states and terrorist states all competing for their place in the world stage. You're seeing one of the biggest changes in globalization we've had since probably the Cold War ended. So I think that's a big change, and that means different alliances, different priorities for different nations. I think we have to really think about what that means in a different sense. I think maybe the biggest thing for us as investors is adjusting to a period of sustained higher rates and higher cost of living. And that adjustment process, working through the global economy, is not a one-time thing and it goes back down. I think we're going to have to really think about higher costs of living and 3% or 4% inflation rather than 2% inflation that central banks were trying to get to for so long. And then the other big change, and these are all, each one of these is a massive shift, but altogether it's going to be a very significant multi-year change, is the reindustrialization of the global economy. And the two big manufacturing hubs for the last 20 years or more were Germany and China, the US less so. And a lot of that's shifting for different reasons. China because of higher costs and they're moving up the value chain. Europe and Germany because of energy costs and energy security and the like. And so I think there's some real issues that are going on there that are going to create some really interesting opportunities for some and big challenges for others. We like the electrification of the world that's got to go on. We like the digitalization that has to continue. The labor issues are going to force nations and companies to do more with less. The national security issue still is going to attract massive capital flows. You're looking at whether it's for defense, and the defense budget just being approved yesterday is a very significant increase and bigger than what the Biden administration was looking for. We're going to be spending more than half of what the world's spending on defense for the US next year. I think you also have food, energy, and cybersecurity in the national security area, and biotech is still a big area to lower the cost of healthcare as people are living longer and costs are continuing to rise. We like the prospects for North America and resource-rich developing nations. We are really concerned about the people who are the leading exporters for some time, that we think the supply chains and the need to bring supplies closer to home are going to challenge some of those economies. But you really have to think about a more sustained, persistent, higher inflation rate environment, and higher interest rate environment. And it doesn't mean we're going back to the big numbers, but it means that you're moving off of trying to get to 2% on inflation and dealing with 3 and 4% annual inflation after we work through some of the current issues. And then you're going to be looking at a significantly higher interest rate environment that we've had for some time. So I think those changes are real, which puts you back to looking at companies with strong balance sheets, reasonable multiples, and reasonable growth. Because in the environment we're describing, multiples can still come down. And we're 17.5, 18 right now on the S&P. And it feels like this environment, that's a little too much. So we do see a number of opportunities. We think that, the defense area is going to do quite well. We think the FANG stocks will be mixed and under some pressure as capital moves away from there. But we'd be reticent to get out completely of a couple of the big ones. We still think there's big opportunities in industrialization and in commodities, and those are not going to change. So we're working on our year-end outlook now, and we'll have that out shortly, Mark, probably end of next week.
Great.
But I'm going to stop there and open it up for discussion.
Thanks, Stephen. So thoughts, questions? Tim, hand up.
Hey, Steve, you probably addressed this before, but sometimes as you talk about stuff, I focus on different areas. You said the Fed, the ECB, and the BOE all raised rates by 50 basis points. Is that actively coordinated? How integrated are these guys? Are they talking to each other on the phone all the time? Does it just sort of kind of happen? I mean, you're obviously not doing things in a vacuum. What's sort of the continuum?
I'll answer that. I think it's coincidence that they all raised 50 this time. I think that just happens. But yes, they have to coordinate some. They've been coordinating since really the great financial crisis in 2008. And the reason for it is when one country moves, everyone else has to react to it on rates, particularly the largest economies. So the global economy is constantly adjusting and reacting to actions taken. So that is part of the reason that they do coordinate more these days, and particularly because it's such the surprises can throw off the markets in ways that are unhealthy as well.
Thank you.
Adam?
Stephen, to follow up on Tim's question there, is that coordination also with the likes of the Bank of China?
The answer would be yes, but to varying degrees. We're in a world where there's always communications going on between governments, even adversaries. And when it comes to this, the two largest economies in the world do have to have communication back and forth. How closely they are on it, I'm not sure right now. It depends. A lot of it went back to the relationships that people like Paulson had and others in government have had. So I'm not sure what Powell's relationship is with his Chinese counterparts. Paulson had very close relations with a lot of them, which really pushed us through the 2008. But I
Okay.
think we're in a different spot now than we were before.
I've got two more quick questions. The first one, the S&P multiple of 718, is inflation priced into that multiple? Do you think?
That's the debate. And it's everyone's views are how much do you think inflation is in the numbers already, and how much do you think still has to go in, and how much do you think the earnings are going to come down because of the inability to keep passing
Right.
on costs. So
Right.
I think it depends on it on everyone's views. So I think what you're saying is what the market multiple is, because it's what the S&P is and what the earnings are for those companies. What the outlook is for it, I think, is going to be what you're setting your base for earnings and where you think inflation is going to be, and that will move it up or down. We think it's probably the hard part is, where do you think inflation is really going to hit in the way that people are thinking? And it's funny, when I was driving, I drove down to Philadelphia yesterday, and I was listening to Bloomberg and CNBC looking for some inspiration for today. And half the people were saying that they thought the first half of the year inflation would be high and then come down the second half. And the other half said inflation was going to come down the first half and then go back up in the second half. So they actually provided me no help whatsoever. So I just said, forget about it. So I think that's the problem, though. You can, depending on your seat, you're going to look at this very differently. And for us, I think you really want to play it not on the extremes then. You want to really focus on quality and conservative growth. And we may see single-digit growth in the S&P next year, which means, that means a lot of companies are going nowhere, and some are going to have some pretty good outperformance. It makes it a stock picker's market.
Okay. The last question is money supply and the multiplier effect on that. The world is awash with cash. You go to London, you go to Dubai, there's cash everywhere. And as the Fed pulls back through tools that they have, is that multiplier effect on money supply in the stimulus and in pulling it back, is it the same? Has it changed?
I'm not really sure how to answer that one.
Well, in the multiplier effect, a lot depends on what your savings are and how much is going into the economy.
Mhm.
And you mentioned earlier that there's a higher level of savings now, if I understood you.
Well,
correctly.
we are working down a higher level of savings. So the stimulus created excess savings that we've been spending down through this process. So that is coming down pretty fast. We overstimulated last year.
You know who, just as a place marker, who has a view on this is Bill Deichler. He's been tracking this with the
Let's
first
get a bit.
repos. And what made you smile so widely, Adam?
Bill Deichler, when I about
Oh,
the first
Oh, there he is. Oh my gosh, he's got
and,
it.
and now
He's here. He is. I was looking
We
for
fully
you.
into the sale.
Sorry,
Did you-
just
You're the-
I'm trying to be off this week, but I can't miss Stephen. So and you all.
You could have missed this one.
No, really good stuff. So
Did you hear the question?
in terms of money supply and all that, yeah, it's been very interesting because if you look at the velocity chart, it really hasn't changed that much. So
in
we're
both
not.
ways, Bill,
Pardon?
hasn't changed that much in both ways as we're pulling back as well as the Fed pulls money back. Hasn't changed.
Yeah, it's been kind of flat as far as the velocity curve. Obviously, number one, velocity is way down. So we're not getting the money turnover that we normally have. And then we did see a little bit of an uptick a little while ago, but since then it's relatively flat. So we're not seeing the type of money turnover that would lead to kind of like more inflation, more stimulus to the economy. And I think that, again, banks are still somewhat reticent to lend. And, we went over the reverse repo discussion last week, and, there's $1 trillion more in the repo market from several months ago. So, banks are happy to get the Fed funds rate there as opposed to lending it out, which would be somewhat, one would hope, to a premium of what they could get in the reverse repo market. So you're not seeing a lot of this money, sloshing around. And, a lot of it, everybody thinks about, huge monetary increase in monetary base, and that leads to inflation. Well, it doesn't happen until it gets into the hands of the consumer.
Right.
And, obviously that's why we didn't have the massive inflation that everybody expected for like the last 10 years. And it was only until the stimulus packages, the direct fiscal stimulus that was sent directly to consumers during the COVID. And all of a sudden, there was cash in the hands of consumers and they began to spend. And with the constraints on supply, then clearly you began to see inflation begin to pick up. So, that's, if I can stay on my soapbox just for a second, that's one of the things that I'm particularly concerned about with regard to the Fed, is that they're using an extraordinarily blunt instrument to try to attack this inflation. And normally if it was like monetary, caused, that would be different, but it's not. I think this was very much supply constraint and high energy prices. Now anecdotally here in Florida, I filled up with gas at Costco the other day, $2.79 for regular. So prices, gas prices have come down a lot. Of course, here in the US, elsewhere in the world, it's a different story. But here in the US, energy prices have come down. Gasoline prices have come down. So, I think it's still a little bit more supply constraint than anything else. So it's a tough deal in terms of what the Fed is doing. And I'm concerned that they're continuing to squeeze the economy and put more, to Stephen's good point, put more people out of work in order to create additional demand destruction. So, that's tough medicine.
1 million to 1.5 million jobs they think might be the number they need to see hit the unemployment lines for then wage pressures to start to come off.
Yeah, I mean, that's pretty sobering if you ask me.
The other interesting thing, Bill, you brought up a great point, because a lot of the QE from the very start of 2008 never got into the system. It was sitting on the bank balance sheets. And that was part of the reason that inflation didn't come, as you described. But the Fed got all the blame for the inflation that hit last year. But I suspect it's the $2 trillion of stimulus that went into the consumers' pockets, and many of them were fully employed, taking 2 checks and getting paid 2 checks while they had jobs from the government, stimulus checks that were completely unnecessary. So you could argue that the Fed was doing what they were supposed to do, and the fiscal stimulus was way beyond what it should be, and was the cause of the inflation. Because as Bill just pointed out, you didn't really see it kick up until you started to see the war in Ukraine and the stimulus that came with that. So I think that is a big element that's creating more distortions in the system.
I had to show Bill playing pickleball. You may have seen there, Bill.
Yes, I had a formidable opponent there.
And everybody can have this discussion live and in person with Bill, because I'm sure he'll be on one of these panels as we brief on what we're seeing in the market.
It looked to me like your foot was on the line when you served there, Bill.
I was, Andrea was,
The ref may not have caught that one.
I did.
other question. And Rob, we gotta see you. This is the time to be in Miami. I'm an anti, well, Basel, boondoggle, but this is where you need to be.
I've noted particularly the Miami part, and I'm penciled in, so get your sports ready or whatever it is.
Yeah. Well, Naples is where the other action is, so just come join us before the weekend.
Hey, Stephen, I got a question for you.
Go for it.
How long is it going to take Jerome and friends to figure out that they're not going to get to 2% inflation? And then, will they ever acknowledge it? And then the other, I guess one way to manage that is they could, and this would be a pretty big change because all these central banks are inflation targeting. But if they went back to sort of targeting money supply, it would kind of take them off the hook from targeting inflation. And, because it seems to me like, we've got this pattern right now where as soon as the Fed talks and they talk about this impossible target, the market just loses all hope. It's almost getting worse that way. Anyway, just trying to sort of figure out what is our cue for, maybe the coast is a little clearer.
I think the one thing that the Fed's been fighting is the market thinks the Fed will start to cut rates next year. And the Fed thinks that until the market doesn't think that, the market's in control and the Fed's not. So they keep reinforcing the message that rates are going to stay higher for longer than you expect. I think your question's the right one. And it's core to our outlook for next year is forget about 2% inflation for a while. You're going to be at a higher level of inflation for some time because it was artificially depressed for a couple of years now, for a decade now. So I think you're going to have them dealing with 3 or 4% is the level that they're going to be looking at, and that means we're also probably going to be looking at 4 and 5% interest rates for some time too. So that reset creates a whole big. That is fundamental, Duncan, to what you just said is fundamental to how you make money next year or lose it. Because if you're not in the mindset that if you don't think that rates are going to go back down and you don't think that inflation is going to go back to 2%, then you have a different mindset for where you're going to put capital. You have to own the beneficiaries of inflation. You have to own the beneficiaries of what's going on, and you have to avoid the companies that are going to be on the wrong end of that. And it really becomes much more of a stock picker's market than we've had. So I think you're onto it. I don't know when the Fed comes to that. I think it will be after the market gets back to where the Fed is in terms of that they're not going to do 2 cuts for next year. And when the Fed feels that the market is not moving ahead of them, I think is when they'll start to be having a more normal discussion about working to a higher interest rate environment and a higher inflation environment.
Right. Stephen, if I could just jump in as well, and kind of picking indicators from the Dallas Fed, like the 12-month PCE trimmed mean inflation is close. As of October was down to 4.7. So what you have is you have a pretty significant narrowing between where that factor is, that indicator, which the Fed has always been a little bit more partial to PCE than otherwise, and where the Fed funds rate is right now. And I think that one of the things, in addition to the employment number, which I think you're spot on, but I think when we actually get like real Fed funds rates, then that might be another chirp of the canary.
Bill, I shared a couple of weeks back the proxy rate that the San Francisco Fed is using, which factors in tightening, and they're up to 650, which would have a significantly inverted yield curve now.
Right. Right.
So that's the way a lot of what the street is looking at now is how do you factor in the tightening that's going on at the same time, because it has a rate impact, and they think it's significant. And As we've talked about, it's a $250 billion a month reversal of money going into the system versus money coming out from the Fed. So I think we might not be as, we might be more inverted than we think if you use the proxy rate, as you are more inverted than we think using the proxy rate. And I think that's probably a good factor to take into account, because we've never really had the type of reduction of the balance sheet going on when we were trying to normalize rates. And I do think that is the big theme for next year, is we're going into a rate normalization mode. And that means we're going to be in a very different, you have to think about valuations of all assets very differently in that environment.
Yeah,
Rob?
absolutely agree.
Hey, Mark, it's Rob. I had just a quick question that either you or Adam might chime in. It might touch a little bit to Steve's point, but just the release of Brittany Griner, I think post the midterms, I think that was a huge move. I'm not sure if it's humanitarian, PR, or what have you. You guys know a little bit about sort of Eastern Europe. You guys have any quick thoughts? Were you surprised at that? Well, not just the release, but the swap.
Adam, you hit that?
Sure. Rob, I think it's really, it highlights the difference in values. Us here in the US versus what Putin does. I look at it as a humanitarian swap. No one wants to do that kind of swap, but when you've got innocent people being kidnapped in a country, which is what happens there, and that's not the only place that it happens. You need to do what you need to do for your citizens. Ideally, Americans wouldn't travel there, but look, we've got a lot of Americans in Russia right now, friends that I have and friends that Mark knows as well. I view it as a humanitarian action. And if we can get more, I personally would support it. Whether that's the right thing to do or not, that's another question. I think it really does highlight our value system versus Putin.
But what does it say that Chris Whelan was stuck there for 4 years? And the administration said that they didn't want it.
Right.
So it was a PR win for the administration.
Whelan's more complicated. I'm sorry, go ahead, Roger.
No, I was just saying that what I found a little bit unsettling was Whelan was there for 4 years. Nobody knows who Whelan is. Nobody cares about Whelan. Griner clearly has a lot of public support. They ran and they saved Griner, and they threw Whelan, to the dogs. I mean, don't forget, Whelan is accused of being a spy. He may have been, in which case the government owes him a little bit more, because he's served his country for 4 years and he's stuck in some hole somewhere. Now the administration came out and said, "Oh, the Russians did not want to swap or have a deal with Whelan," but that's just them covering themselves because of the criticism that they're just running to save a WNBA star as opposed to a guy who secretly served his country for for how many ever years. I just thought it was a bit.
Yeah, I hear you, Roger. I think Whelan's a different discussion. There is another American there that taught at the Anglo-American school who's been jailed for a couple of years now. Also on drug charges.
Another thing, we're going to be in Dubai, and I know they may not be physically present, but basically the Russian diaspora is becoming, if not already, the majority of the population of Dubai.
That's right.
98% or 99% oppose this war. It's a very interesting time, and some others who are of that ilk have been encouraging me to go to do an event in and around it, and it could be an interesting pivotable, influential group. Not they can't push the Kremlin, but it's just an interesting concentration of exiles. Turkey too, but that's in
Well, Dubai is the biggest concentration right now.
in
Real
Israel.
estate prices, real estate prices have gone way high. I see that as also opportunity for the future in terms of what happens in Russia post-Putin. Which I still believe, I don't see how Putin keeps this up beyond 2023. That's my own personal opinion. How that changes, I don't know. But there is a lot of opportunity, I think, in terms of what's going to happen next, not only in Russia, but also Ukraine, obviously.
So Leslie, you had your hand up. I threw some Ohio or some Florida images up there for people. I want to entice you down to Florida. So come. Okay, keep going.
So I guess my question has to do bringing it back home a little bit to food security and food supply. I'm left after, hearing of these macro trends that are moving in a direction that suggest less importation and a lot of social needs. The vulnerable communities are going to be the ones who are already feeling the impacts. And I was just kind of curious whether there's some good ideas for future dialogue around the relationship of commercial real estate in urban environments and food security, like in the area of urban farming and vertical farming. And I'd love to talk to other people who are sort of interested and aligned in those areas, because it's not something that I have a full point of view on yet, but I think there's some interesting opportunities.
Leslie, it's a very good point you are raising here. We are planning to have this New York event, Impact Summit in March, covering energy transition, but also food. And we will do some further food things in Singapore in November, where we have also some things ongoing. So we're planning to do this, and all of the assaults are very welcome that we can plan the agenda accordingly, to cover that as well. So this is definitely a topic which is from Mark's and my perspective on the highest level, and we will support this and all of the ideas around that one.
And adding on to what Michael said, because it was really good with Michael and Jim. We've been sitting back and trying to plan for next year over the last couple months. There's a fund group that we're looking with that's raising 20 to 40 billion focused on food production out of first New Zealand and Australia, but throughout. What's interesting and in Africa, and it comes from I guess I can't talk about it just yet, but it comes from solving some problems on two sides of the supply chain. And interestingly, no alignment with China. It's all ex-China. I think that's why I want you to predict 2023 and beyond. I think China is going to is hitting itself in the gut right now on so many levels. And by the way, India on the rise. I shared something. So it goes off your question. Sorry, Leslie, but I like to get us to think about the future predictions, and the food took my chain of thought to that. But back to you, is the Impact Summit. We'll have 2 days in New York to focus on that, and food is one of the themes, definitely.
Just Mark and Leslie, I mean, I'm glad you brought up that point, but there's a larger point here that needs to be frankly discussed at the summit and all, and it's Florida and Texas, where there is political, frankly, assault on ESG with respect to cancellation of allocation to ESG related strategies. This is I'm in New York for a visit. This is a really in-depth, tough topic that involves both dollars, jobs, subject matter. And I'm keeping politics aside. It's just, clearly there's an agenda to that. But, this is, these are hundreds of millions of dollars that are being diverted because of policy. I'm not sure if Bill or some of the Florida guys or Texas guys have opinion, or Mark, have you studied that?
Well, It's interesting because I always been the only independent, I think we need to bring people back together. We did that with the energy, we don't always have to violently agree in a silo. We can actually have different opinions, and we showed it on energy transition. If you're to the extreme, then we have no carbon. We can't afford not to have carbon in the next 30 years. We have to be smarter about how we do it. We want to aspire to hydrogen. Governance, there should be no question, social, but I think the energy transition requires a more nuanced. But maybe Stephen Burke, we've been talking about these allocations. Well, some of it, people have been fulfilling it in a greenwashing way anyways. I think everything should be rethought a bit more. There's too much just momentum, herd mentality on both sides, but other opinions.
Well, there's a lack of definition, or there's multiple definitions that make it hard for a company. At ARS, we didn't go out and advertise ourselves as ESG because I didn't think we'd be able to fulfill the mandate.
Right.
And I don't think most companies can, including people like BlackRock with $9 trillion, right? It's hard to do around the loose standards that exist and be in compliance on a regular basis. So, everyone's definition is different. You have to have a better starting point. I think that's one of the challenges. I think the other challenge, Leslie, and bring it up for how innovation is going to get us there, is governments don't have the financial capacity to solve all the problems that they have to solve now. And I think that's really the big issue. After spending all the amount of money we spent over the last decade, now we have to make really hard choices, and it's going to be much more difficult, which means the private sector has to get more involved in innovating to get the solutions to this problem.
I agree completely. And connecting capital sources with innovation and startup entrepreneurs who, can be kind of conjoined with mentorship, that's a pretty good spectrum to think about. And I think it would be really interesting for one of our future discussions to brainstorm around the definitions of words such as impact, how we interpret ESG, sustainability, they're kind of thrown about, but we might want to just have a conversation about how those can be best defined in the future.
Well, if you look at it, I think the UN sustainability goals is something like 180 goals, something like that.
Well,
which ones do we work on first?
17 UN SDG.
Yeah.
Then they break down, Leslie, into category 2s and category 3s. Well, look, I think no one can argue that we have a problem with prisoners and both the size of the population and a problem with the reentry. Like, well, however you want to define it, giving relief to Ukrainians, finding access to healthcare, and whether there's what I like about SDG categorization is hopefully there's measurement, and then people are coordinated at the very specific micro levels. Andrew, you had a question?
Yeah, in the same realm as the last topic, and thanks again, Stephen. I've been reading a little bit about the increased positions that BlackRock and Vanguard are taking in public utilities. At what point does that become problematic in your mind?
It's interesting. They're so big that it's hard for them to get full position sizes or market weights in some of the areas because they'll actually, own all the area. So it's not, in some cases, not possible for them to get full exposure into areas at their size. So it's really an interesting challenge that some of these big firms have in the environment. I just think we're at a period where this is going to be a tough period for all these issues because there's so many demands on businesses and on governments, and the needs are much greater than we can deliver on. So I think we're going to be in a period where you're constantly going to be fighting for what gets the money, and who's it coming from, and how do we pay for all this stuff. And I think that's and you're doing it with a higher interest rate environment, a higher inflation environment. Trade-offs have to happen, and things have to be prioritized better. I think that's going to be the hard part for moving things forward. And the hard part for investors to decide where does capital have to flow to, and given the problems that exist today.
Other comments, questions? Roger, thank you for hosting me at your Christmas party or holiday party. Jeff So,
More than welcome.
Hey, Mark.
you want to, I don't want to pigeonhole you, but you're into, I think it's interesting how do you see Korea in today's landscape?
I think it's interesting because clear lines are being drawn, right? Around a US centric sort of sphere of influence out in Asia versus China, and Korea has certainly made, while publicly they're speaking about being sort of neutral because of the economic impact of China, I think, it's clear to me that Korea is firmly in the US camp. So I think it's interesting. I did have a question for Steve though. With China opening up again, right, with the zero COVID policy being
Amended.
Transitioned, yeah. I'm curious to hear your thoughts around supply chain issues, where you see impact here in the US in the coming months.
It's interesting because there's articles out today that with their reopening, one area you might see some impact is on the supply of medicine and pharmaceuticals. There's, the UK has a shortage of antibiotics right now for kids. They're worried about as we go into the winter. I think Europe has some other issues. We've had Puerto Rico without the production that they were producing for some time. So that's one area that you're going to see potential if they decide that they need to keep medicines there. Do they distort the pharmaceutical market? I think you're going to see on a reopening, I think it could really have a big impact on the commodity complex and the both industrial metals, rare earths, and also in energy. I think those are all areas we could see some real challenges in as well. I also think the other thing, with Japan right now, and it gets to Mark your question on Korea and the Middle East and the Asia Pac, the Japan national security strategy came out last week. We want to talk about that next week. And the US released theirs 2 months ago, and they actually look very similar and with similar concerns that they're working on. It looks like they're written in some cases by the same people. So it's really interesting what's going on there, because Japan, they're talking about doubling their defense spend. I know Korea's got to think about what they're doing there. So you're really starting to see that complex pick up. And we think that's going to be a phenomenal area for investing next year, is the US defense industry. So, and then the other question, answer Jeff, on your question, I think steel, was another area that's going to have a big impact on that as well.